Imagine this scenario. You are successful. You worked hard. You decide it's time to buy the trophy home. You look at Sydney's prestigious Upper North Shore. You find the king of the street, a brand new architectural masterpiece. It just settled last year. The price tag? $6 million. You hand over the check. You move in. You think you've made it. And then, the rain starts. This isn't a hypothetical. This actually happened recently. A $6 million home, less than a year old, was brought to its knees by heavy rainfall. The roof design, sleek and modern as it was, couldn't handle the volume of water. The drainage failed, the water pooled, the weight became too much, and the ceiling literally collapsed. Now, I want you to put yourself in that owner's shoes. When they signed that contract, looking at the fresh paint and the marble bench tops, do you think they ever imagined their living room would turn into a swimming pool 6 months later? Of course not. Welcome back to the Aussie Property Truth. Today, we are having a hard conversation about new properties. We are conditioned to love new things. New phones, new cars, new clothes. But in the world of Australian real estate, new can often mean nightmare. I used to sell these properties. I was the guy in the suit showing you the glossy brochures. But today, as an investor, I won't touch them. In this episode, I'm going to break down the 5 critical reasons why I refuse to buy new builds for my portfolio and the one single exception where I might break my own rule. Before we get to the list, we need to talk about game theory. Whether you have $500,000 or $50 million, when you walk into a display suite, you need to understand your position in the food chain. You are a retail buyer. You are the scattered investor. Who is sitting across from you? The developer, the builder. Think of it like a casino. The developer is the house. They have crunched the numbers. They have the actuaries, the architects, and the quantity surveyors. They're in the business of profit margin. If they're selling a finished product to you, they have already extracted the maximum value from that land. Now, I'm not being a total pessimist. Are they good new builds? Sure. Look at the ultra-luxury market, places like Barangaroo. Those apartments launched at $10 million and are now trading for $20 million. But that is the unicorn market. That is the 1%. For the rest of us, the 99% trying to build family wealth, we deal in probabilities, not exceptions. And the probability says, don't bet against the house. If you're buying a home to live in and you don't care about the price, you just want that fresh smell and no previous owners, that is fine. That's a lifestyle choice. Happy wife, happy life, right? But if you're listening to this show to make money, to secure your retirement, then you need to listen very closely to these 5 red flags. Point 1. The curse of infinite supply scarcity. Let's kick off with reason number 1, the death of scarcity. The first rule of Economics 101 is supply and demand. For an asset to grow in value, it needs to be scarce. When you buy a house and land package in a new estate, or an apartment in a high-rise precinct, you are buying a commodity. If the developer sells out stage 1, what do? They release stage 2, then stage 3. Then the farmer next door sells his land, and suddenly there's a stage 4. I learned this the hard way. Years ago, I bought an off-the-plan property. I thought I was a genius. But when I tried to sell a few years later, I wasn't just competing with other resale homes. I was competing with the developer who was still building brand new stock down the road. Why would a buyer pay me a premium for my used new house when they can buy a brand new house next door for the same price? I ended up losing the opportunity cost of my money and took a massive hit on the exit price, about 10 to 20%. If you want capital growth, you need to own something they aren't making anymore. They aren't making any more Victorian terraces in the inner city. They aren't making more land 5 kilometers from the CBD. But they can print new apartments and new estates forever. Point 2. The guinea pig risk, no track record. Moving on to reason number 2, the blind box factor. Buying a new build is like buying a mystery box. It has no history. It has no track record. When you buy a property that's 30 or 40 years old, it has stood the test of time. The foundation has settled. The cracks have appeared and been fixed. The strata committee is established. You know if the neighbors are crazy or if the sinking fund is healthy. With a new build, you're the test dummy. You're the guinea pig. You don't know if the basement waterproofing will hold up. You don't know if the strata fees are artificially low just to get you to sign, only to triple in year 3. And let's talk about the builder's warranty. In Australia, we have statutory warranties, usually 6 or 7 years. But have you ever tried to get a builder to come back and fix a defect? It is a soul-destroying process. It could take months, sometimes years. And that's assuming the builder hasn't gone bankrupt, which, let's be honest, happens all the time in this industry. While you're fighting the builder in court or waiting for them to fix a leak, the bank still wants their mortgage payment. They don't care that your investment is a lemon. Why take that risk? Point 3. The illusion of quality hidden materials. This leads perfectly into reason number 3. What you can't see will hurt you. When you walk into a display home, you see the surface, the paint, the tiles, the carpet, but you cannot see the bones. I have a mate who built a new house recently. He trusted the builder completely, didn't hire his own private inspector. Big mistake. A few months after moving in, he was drilling a hole in the wall to hang a picture. He accidentally nicked a water pipe. He called a plumber to fix it. The plumber cut open the plasterboard, looked at the pipe, and shook his head. He said, "Mate, why are your hot water lines made of cheap plastic? This should be copper." My friend had no idea. He paid for a premium home, but somewhere down the chain of command, from the developer to the builder to the subcontractor to the apprentice, someone decided to cut corners to save a few bucks. If there are any building inspectors listening, you know exactly what I'm talking about. You see this every day. Missing insulation, non-compliant waterproofing, cheap substitutes. Unless you're standing on that construction site every single day with a whip in your hand, you are relying on blind faith. And in the current construction market, with rising costs of materials and labor, builders are under immense pressure to cut costs. Do you really want to be on the receiving end of that cost cutting? Point 4 and 5. The financial traps, premium, and depreciation. Now let's talk about the money. Reason number 4, the new premium. New properties carry a price premium. It's the shiny object tax. You're paying an extra 10% to 20% just for the privilege of being the first owner. This is driven by emotion, not logic. Remember, land appreciates. Buildings depreciate. When you buy a new apartment, the vast majority of your purchase price is paying for the building, the marketing, the agent commissions, and the developer's profit. Very little is actually securing the land value. And finally, reason number 5, the depreciation trap. I hear this constantly from accountants and investment gurus. They say, buy new because the tax deductions are amazing. You get huge depreciation benefits. Let's use some common sense here. Depreciation is the tax office acknowledging that your asset is losing value. Yes, you might get $15,000 back in tax, but usually that's because you overpaid by $50,000 in the first place. You were spending $1 to get 30 cents back. That is terrible math. I have clients who buy ugly 40-year-old houses on big blocks of land. They still get some depreciation, which is about $10,000 a year on the fixtures and old renovations. But the difference is their land value is skyrocketing. Don't let the tax tail wag the investment dog. So is that it? Do I hate all construction? Not entirely. I promised you I would tell you the one exception. The one time I will buy a new property. I will buy new, only if I am the one building it. This is the wholesale approach. If I could buy an old house, knock it down, and build 2 townhouses, I am now the developer. I am the one capturing that 20% profit margin. I am the one controlling the quality. I ensure the pipes are copper. I ensure the waterproofing is done right. I am creating equity through effort, not paying a premium for someone else's effort. But walking into a showroom and paying retail price? No thank you. To wrap this up, the property market is unforgiving. It doesn't care how nice your kitchen looks. It cares about location, land value, and scarcity. Don't be the person holding the bag when the ceiling collapses. Don't be the person paying for the developer's Ferrari. Be the smart investor. Buy the land, buy the history, and buy the scarcity. That's it for this week's deep dive. If you found this helpful, share it with a friend who is thinking about buying off the plan. You might just save them a fortune. Thank you for coming to this video. We'll catch you next time.